With less than 20 days until the presidential election and 2 more rate decisions before the end of the year, Treasury yields could see some volatility in the upcoming months. But what does that mean for your portfolio? And how can you best position yourself? Joining us now, we've got John McClain, portfolio manager at Brandywine Global. Great to have you here with us, John. So first and foremost, there's a multitude of factors that are playing out right now that investors have to keep in mind, especially with just a few weeks left here, several weeks left, I should say, here in the fourth quarter as we're trying to round out some of the performance that we've seen over the course of this year that's held, 46, 47 record highs. So all these things considered, where should investors be looking through some of the earnings that have come out this season and trying to position their portfolio for the fourth quarter?
Yeah, well, look, I think we're off to a good start in terms of earnings, and that's what really we're paying attention to. And you've seen heavyweights like Schwab, JP Morgan, and now Morgan Stanley deliver both top line and bottom line growth. And what we're hearing from them is very positive, right? Net interest margin is holding strong. There's demand for loan growth, and we think the economy is positioned well going forward here. So what we have is, yes, the election coming up, and there will be volatility around that. And we think you're supposed to buy any dip at this point. This feels very much like 2019 and 2021, end of the year melt up, a lot of risk chasing in the marketplace. And so we believe that investors are served well being in the market at this point in time. And after we clear the election, that uncertainty goes away and the market's going to like what it sees on a go-forward basis.
Okay, all dips are not created equal though, John. So what are the perhaps dips that you're watching that are most ripe for opportunity long-term?
Well, yeah, look, I think you see tech heavyweights like ASML. That's very interesting from our perspective. This is a company with probably the widest moat available. And so, yes, there will be earnings hiccups, but we believe that buying high quality businesses makes a lot of sense at this point in time. We also think that if you see a meaningful pullback in the S&P here with election angst, you're supposed to take advantage of that because we do still see reasonable earnings growth going into 2025.
And what about post-election?
Yeah, from a post-election standpoint, again, we believe that the overhang that's in front of the market here goes away, and the focus goes back to American exceptionalism in terms of the underlying growth of the businesses that permeate the S&P 500. And again, we're going to see, I think, strong earnings growth in 3Q and on a go-forward basis. And let's not forget that monetary policy is loosening at this point in time. So we have loose fiscal policy, we have wide open financial conditions, and we have a reasonably stimulative balance sheet. We think that is very supportive for risk assets across asset classes.
And then just lastly, John, while we have you here, one thing that really stuck out to me in your view here is you wouldn't be surprised if we're talking about rate hikes again in 18 months. What would need to play out in order for that to be the case? Because that puts us at Q1 of 2026, that we would be even in the thought process, which means that leading up to that, we could potentially be seeing the Fed have to acknowledge that.
Oh, absolutely. Look, as I laid out, monetary policy can't be looked at in a vacuum. It is restrictive. It's getting less restrictive, but everything else, financial conditions, fiscal policy, and the balance sheet are stimulative at this point in time. So it's that rate of change, it's that change in monetary policy is going to lead to asset price growth. It's going to lead to things like home price appreciation, which is going to create inflation again in the marketplace. And that Fed dual mandate is going to shift back to thinking about inflation. But that, again, is a 12 to 18 month time frame from our perspective.
All right, John McClain, portfolio manager at Brandywine Global. John, thanks so much for taking the time here with us today.